Welcome to Beyond the Bottom Line. Today, my colleague Paul Roth and I will be talking about municipal bonds, a $4 trillion market, and some of the hazards in that market. Our guest is Dick Ravitch, and I'm going to leave it to my partner, Paul, to introduce Dick.
Dick, thank you so much for being with us today. You've had an extraordinary career both in the private sector and in the public sector, being Lieutenant Governor of the state of New York in 2009, brought in with the idea of fixing up the New York State budget. You've been a student of municipal and state budget and pension obligations, and you wrote with Paul Volcker, did a crisis report on it. You've been a consultant to Detroit and Chicago and Puerto Rico, so there's nobody who's better equipped to talk to us about what's happening. Let's start with saying, what's going on? Why are there so many states and cities who are hopelessly, it seems, in debt, who have pension obligations that are beyond belief in terms of unfunded, and what are they going to do it? How did it come about? And maybe you could use an example such as Puerto Rico to explain how does this happen, where you've got $70 billion of municipal debt, you've got $50 billion of unfunded pension obligations, you've got 3 million people on the island. So what's the hope of tackling a problem like this?
Well, let me start answer the first part of your question. There was no collective bargaining for public employees until the early 60s. That coincided with the expansion of activity that government engaged in: social services, education, anti-poverty, low-income housing. So the employment by state and municipal governments grew exponentially in the 60s. When they were unionized, they had used their collective bargaining leverage quite appropriately and honorably to get wage levels that were comparable to what those people in the private sector. And then in the 70s, when there was a recession, the economy slowed down. The political system started providing these employees with the full consent of the unions, with promises for retirement benefits, health care benefits, and pension benefits, which, because they did not budget in accordance with generally accepted accounting principles.
Why not?
Because
Why weren't they budgeted with GAAP principles?
they didn't, because if they had, they couldn't have afforded to make the promises they made.
They would have been bankrupt if they had done
That's
it according
correct.
to
So
GAAP.
They said, we'll give you all these benefits in the future, and because they budgeted on a cash basis, nobody raised any objection.
It was somebody else's problem then to pay it off.
It's their successor and their successor's successor's successor.
No, wait a minute, let me understand this. So are we saying that they made these promises and they borrowed to fund these promises?
No, they just didn't face up to the risk of not having enough revenue in the future to meet those promises.
So they deferred the obligations, in effect.
Yes. And then they ended up borrowing to meet them.
So wait a minute, if you borrow to meet these obligations, isn't that the definition of a Ponzi scheme?
The answer is yes. But I don't think it was done in bad faith, but I've never yet met the politician who wouldn't rather borrow than tax.
I mean, that's the dynamic, isn't it?
That is the dynamic.
I mean, the dynamic is things were in a recession. We had to figure out a way to meet the demands of the workers. So we gave them future benefits, which didn't hit the current.
That's correct. Except in New York, when New York had its fiscal crisis, we put into the statute a requirement that New York City had to budget in accordance with GAAP. And that's why New York City has never had a fiscal crisis.
Is New York City now unique in budgeting according to GAAP?
Well, I think North Carolina has something close to it, but
this,
nobody else does.
this is a $4 trillion market, and I gather from what you're saying that the overwhelming number of dollars are not budgeted in accordance with GAAP.
Well, let's separate out. As you well know, cities and states borrow for several reasons.
Right.
They borrow primarily to fund capital projects. Over 80% of all the infrastructure in the United States is financed by states and cities, not by the federal government. There's a lot of public misconception about that. And they issue debt for that purpose. The second kind of debt that city and states issue is interyear debt, bond anticipation notes, tax anticipation notes, to enable them to have cash over a 12-month period so they're not tied to the month that they receive taxes. New York City's fiscal year is June 30th. New York State's fiscal year is March 31st. So they've been playing games about moving obligations and revenues in between to enable the city to be able to have a balanced budget. But there is always, I put it gently, an optimism that the economy will roar, revenues will grow, and we'll be able to pay it off. It was only when they found that they didn't have enough revenue to meet their obligations that they started borrowing for purposes other than infrastructure and other than intra-year cash flow needs.
Can you put this in some kind of perspective in terms of what is the debt that's out there that has to be serviced and the pension debt that's out there that needs to be serviced?
The OPEB obligation, GASP, the Government Accounting Standards Board, requires states and cities now to reflect in their CAFRs, in their annual financial statements, what their unfunded healthcare liability is. And I think that totals well over $1 trillion. There is no comparable requirement for pension obligations, in part because the adequacy of the funding depends on the assumption you make about what the interest rate will be on the existing corpus of the funds. And if you assume, as they do, 6 and 7% returns, then the liability, the unfunded liability, is very minimal. But to assume a 6 and 7% return when a AAA corporate bond earns you 3% or 3.5% is a little silly. But I mean, I could go on and on about the number of people that did that. GASB at one point proposed a rule that would have required states and cities to put 4-year projections into their annual financial statements. The chairman of GASB asked me to testify at a hearing in favor of it, which I did. I was followed by the U.S. Conference of Mayors, the National Governors Association, the National Association of State Budget Officers, and they all testified against it. And when we had the cocktail period afterwards, and I knew all these people, I said, why? And they said, come on, Dick, you know, the people we represent don't want more transparency.
So you mentioned this more than $1 trillion in unfunded health benefits. Then there's pension benefits.
Yes.
How big is that?
Well, it depends what discount rate you want to use to.
But it's a very large number.
Oh, yeah, it's
a very large. So now let me ask you the follow-up question. We started, Paul mentioned Puerto Rico. Puerto Rico, we said, has $70 billion in municipal debt, $50 billion in unfunded pension and healthcare and the rest, $120 billion, 3 million people. How did we get here? How was this borrowing permitted? How did the underwriters sell the bonds? And then just for our audience, I should say, bonds are not bought, they're sold. Somebody makes the telephone call to buy these bonds.
The competition between the major money market funds to get customers, to get widows and orphans, to give them their money to invest, they competed with one another by offering the highest yields they possibly could. So it became a circular problem. And if they could get a higher yield from a Puerto Rican bond that was rated investment grade at least, they would buy those. Did they have any real understanding of the creditworthiness of what they were buying? No. They relied solely on the ratings.
This is a huge market, and there's virtually no transparency in terms of how things are going to be paid for.
Well, that is because the Congress of the United States passed what is known as the Tower Amendment, which excludes the SEC from having jurisdiction over the issuance of municipal bonds. So if I, as a businessman, want to raise money from the public to build a building, to create a widget factory, I have to submit the papers to the SEC, and they have to look at the projections and the analysis.
Adequate disclosure.
Yes, adequate disclosure. No such review exists for the issuance of municipal bonds.
But even to go sort of plumb this a little bit further in terms of what you were saying, if you're a corporation regulated by the SEC, your financial statements have to be done in accordance with GAAP. If you're a municipality or a state and you're borrowing and you're doing it on a cash basis, how do you evaluate what the liabilities are going to be and what the assets are going to be and what the revenues are going to be to pay it off?
That's the problem. To the extent that the politician can kick the can down the road, they will do so. Let me give you an illustration. During the very brief period when I was lieutenant governor, the budget director submitted a draft budget which included the following provision. Because of the revenue shortfall, this was the day after the market collapse in 2008, the proposal was that instead of contributing what the actuarially required amount was to the state pension fund, they put a provision in that said the state could borrow the money to put into the pension fund. And that loan would bear a 3% coupon. The pension fund's actuarial assumption was that they would earn 6.5%.
So suddenly the state was in the arbitrage business.
That's correct. Borrowing money to cover a when I asked the unions, how do you let your members, your retirees, take these risks? They said, Dick, we were told by the government that if we didn't go along with this politically, then they would have to lay off thousands of workers. I then asked your colleagues on Wall Street, I'm not going to name them, at a breakfast, why don't you say no, stop underwriting this stuff? This is ridiculous. Dick, oh buddy, you don't understand. If we say we won't underwrite it anymore, all the banks in Chicago and
Somebody else will.
somebody else.
That's an excuse Paul and I hear in the classroom all the time. If I didn't do it, somebody else will do it.
That's correct. Puerto Rico is the most egregious example because several things happened as well as excessive borrowing. They, ironically, former governor who now represents the monolines, the bond insurance companies, when he was governor, borrowed $17 billion, essentially to cover operating deficits.
That's my definition of a Ponzi scheme.
Yes. I don't mean he did it in bad faith.
And I understand.
No,
But it was sort of interesting when he led the fight against the enactment of bankruptcy authorization legislation in Washington, which I was involved in. But that's the most egregious example. But the reason it is as bad as it is not only was the borrowing excessive, but U.S. government had provided a mammoth incentive, tax incentive, for companies to move to Puerto Rico. They accepted the income. In 1996, the father of the current governor was then the governor, and he went to the White House and to Newt Gingrich, who was Speaker of the House, said, we're going to be a state. We don't really need this unique tax benefit. Gingrich wanted to reduce federal expenditures or increase federal revenues, wanted, in other words, to diminish the deficit, and the Republicans had taken control of the Congress, and they cut a deal with the Treasury Department and agreed to phase out what's known as Section 936 of the Internal Revenue Code. So over the next 10 years, all the companies the big pharmaceuticals, Walmart, etc.
They all left.
Well, a lot of them left as their tax bill
Yeah.
grew and grew and grew.
Paul,
Then they passed a law saying the taxes they paid were creditable against federal income taxes. And the Internal Revenue Service never issued a ruling saying that's true, and I suspect that's a ticking time bomb in Puerto Rico. So you had an expiration of a subsidy, you had excessive borrowing, and you had no discipline whatsoever in the political system down there to do anything. Because without mentioning names, a lot of people we all know, a lot of institutions that are highly respectable and wonderful institutions were flying with regularity to Puerto Rico, telling them what they could hawk, how they could borrow, that they could keep borrowing more and more money, despite the fact that the Constitution of Puerto Rico said you cannot use more than 15% of your revenue for debt service purposes.
Dick, I just want to stop you for 1 second. For the benefit of our audience, I just want to make clear that Puerto Rico was in a unique situation in that it was triple tax exempt. City,
correct.
state, and federal. It was the only institution, I think, in the country that had that.
That
ability.
that enabled them to borrow
So
at
they
a
can
cheaper
borrow.
rate than they would have.
So now let's ask the question. Someday there has to be a settlement of this.
Yes.
And the question Paul and I always talk about in our classroom is who gets what? The bondholders say, well, we're entitled, we have a first claim. On some of the revenue bonds, we have the assets, we have a call on the assets. The people who work in Puerto Rico, they want their pensions paid. The employees of the state government, somebody's got to pick up the trash and be the cops and be the firemen. How is the corpus divided?
First of all, under the leadership of the Treasury Department under Obama, under Jack Lew, Antonio Weiss, I was a helpful kibitzer in this process. We got a law enacted by the Congress that permitted Puerto Rico to file under the bankruptcy law. Number two, that statute created an Oversight Board, not dissimilar conceptually to the Oversight Board created in New York in '75, or the one created 5 years ago in Detroit. And that board has a lot of power. The government of Puerto Rico at this point can't spend money without the board's approval. There are, because of the degree of insolvency, there's very little the board can do. So when a judge was appointed, a bankruptcy judge, Laura Swain, who was a very reputable judge from the Southern District here in New York, she said she wanted to have the dispute amongst the creditors mediated. And they recently came up with a proposed settlement that would allocate a certain amount of the Commonwealth's revenues that are paid in the form of a sales tax to the holders of the bonds that was secured only by the sales tax.
I think I don't want to get too deep in the weeds on this, but I always fear that the working person, the laborer, is going to get really hurt in this before it's all over. That it's
They
not
have been and they will continue to be. It is still uncertain after this board is 2 years old and has been functioning. There is still no clear understanding as to how much revenue is available to service debt.
And what about the pensioners?
The pension, the plan, the fiscal plan contemplates the payment of not 100%, but 80 or 90% of the pensions.
So it's like what happened in Detroit, that they're trying to develop a plan to pay off.
No, there's a big difference,
What's that?
fundamental difference. And that is in Detroit when we went through the bankruptcy process.
Right.
And there was very little, if any, dispute about what the revenue numbers would be. So that the process administered by Steve Rhodes, who was the bankruptcy judge, and Jerry Rosen, who was the chief judge of the district court, the process was a mediation with all the creditors. Since you knew a revenue number, you had X dollars available to service debt. There was no disagreement as to what the minimal amount of money required to run the city, to pay police and fire and keep the lights on in the streets. So they had a net number that's available. Then they had to get all the creditor groups, pension beneficiaries, bondholders, anybody else.
Workers, contractors.
To take haircuts so that the total of obligation left was no greater than the nut. In Puerto Rico, the uncertainty of revenue made it impossible to start off with a clear revenue.
They didn't even know how much cash they had in the bank. I just read where they discovered some bank accounts they didn't know about.
Well, that's absolutely true. And in point of fact, there weren't even audited financial statements.
Looking to the future, has anything changed in the dynamics that brought about Puerto Rico and Detroit that is going to alleviate the problem for cities and states going forward?
No, sir.
So we can expect we're going to see more of this.
I would tell you, well, New Jersey, Connecticut, there are many jurisdictions that are in Illinois, incapable of meeting their obligations.
But and no one is pushing a situation where greater transparency will allow people to see exactly, because it's sort of against the political dynamic to push that kind of transparency.
Well, there are people arguing in favor of it.
I know they're arguing in favor, but how successful are they being? I mean, you're one of them that's arguing in favor of it.
Look, it's very, very tough. When Rahm Emanuel became mayor of Chicago, he tried to be responsible about their budget problems. And he got a legal opinion from a very distinguished law firm that said, you can, despite the fact that the Constitution of the state of Illinois says that public pension benefits are protected constitutionally, you nonetheless, despite the way that provision in the Constitution reads, you have the ability to modify pensions to the extent of the unserved term of your employees. So Rahm did a very responsible thing. He said, I'm going to cut back pension benefits, but at the same time, I'm going to do the following things to try to increase revenue. So he favored an increase in some of the taxes that the city collected to compensate for this. And along came the newly elected governor who announced, I'm cutting taxes 40%.
So what you're telling me right now is we're selling bonds around the country that can never be paid back.
I believe that I wouldn't quite put it that way. I would say people are lending money to governments without having adequate evidence of those governments' ability to pay that money back.
That's why you were once lieutenant governor.
Dick, I want to thank you very much. This has been a wonderful conversation about the problems of the municipal debt and pension situation. And there's nobody better that could educate us with respect to it. So thank you very, very much for
My pleasure.
appearing with us. And to our audience, I hope that you will join Larry and me on our next session of Beyond the Bottom Line. Thank you.